You're 59 and a half. You're still working and you've built up $650,000 in your 401k. The question you are asking now is, should I consider converting some of this money to a Roth? Thanks for joining us. That's what we'll be discussing today. Hello, my name is John Vandergriff. I am the wealth planning team lead and one of the owners here at Blue Ridge Wealth Planners, where we help people create plans for their retirement to either transition very effectively into those retirement years, or if they're already enjoying those retirement years, make sure that we plan for the things that help them to enjoy those years for as long as they have left. And so one of the topics that is top of mind today, for good reason, is taxes and tax planning. That's going to be the basis of our conversation today. And whenever we have these videos, I always like to point out two sort of disclaimers, things to be aware of before we get started. First, we're going to go over a very specific situation. Your situation may be similar to this, but make sure that you consult a CPA, tax professional, tax advisor, or some type of financial planner that works in taxes before you make decisions just based on this video, because again, there could be some things about your situation that are individual to you that are not being factored into what we discuss. The other is make sure that you like, share, subscribe the videos that you watch with us. That helps us to be able to get this message out to other people, but also can get it to where you can get more of this content as we release it. So with that being said, we're looking at a 59.5-year-old working with $650,000 in their 401k. Question becomes, should I convert to a Roth? We'll talk about why 59.5 is such a specific age that the government picks out and how that will affect the different things that you consider here. But like we talked about, to plan effectively for retirement, we have created what we call a plan for everything, which is where you really need to plan for 5 baseline areas of retirement: your income, investment strategy, taxes, healthcare, and then family legacy. The more you go into this conversation, the more you start to see these things really overlap and affect each other. We're going to focus primarily on income today, income in the future, and how that affects your taxes. But again, all these things are going to be, intermingled and need to fit together and move in the same direction for you to have the most optimal situation you can. So again, in this particular scenario, what we're looking at is a married couple, age 59 and a half and 62. $50,000 of combined income today. Their total is $650,000 in 401ks, and they have minor amounts in bank accounts, but not enough in there for us to potentially use to pay for the taxes. So we're really going to focus in on their 401k today. They're planning on working another 5 years. Whenever they do get to retirement, their combined Social Security at that time would be $3,500. Or $42,000 a year. Their income needed at retirement would be $4,000 a month or $48,000 a year. So most of their income will be coming from their Social Security. So not a lot of income need here, but again, we want to focus on whether getting this money into a more tax strategized or tax-free position in Roth is a good decision for them. So as we look at this, the reason 59 and a half is such an important age is that is when the government has decided that once you reach this age, you no longer have a penalty to access your money in your Roth account or your IRA or 401k. So as we look at this, it's important to cross that threshold so that we don't have a penalty, but also if you do any conversions after the age of 59 and a half, as you see here, your principal will be available to you during the 5-year waiting period for your growth to be tax-free. So you could access what you convert and then access the growth later. Because when we look at this, things to consider with Roth conversions: first, moving money out of a 401k or IRA, it is a taxable event, so whatever money you take out will go on top of, in this case, the $50,000 of income that you have. Roth IRAs need to be in place for 5 years before the account is fully accessible for tax-free benefits. But like we said, if you're over 59 and a half, your converted amount would be available to you during that 5-year window. So if you did $100,000, that would be available, but if it grew to 110 and you liquidated the account, that $10,000 extra would be taxable to you. So again, 59 and a half becomes a very important age, especially if we need to use some of this money in the conversation for converting these dollars. And again, just being in a position where they get overall enjoyment from these monies in a tax-free fashion. So as we look at this, this particular situation, as we kind of zoom in on our plan for everything here, so we know 5 years from now they'll have Social Security combined at $3,500 a month. Their annual income need is $48,000 a year. Their wages are $50,000. So there's no need that they have off of their savings, and very little need that they'll have off of those savings by percentage whenever they get to their retirement years. But today their income is $50,000, which would translate up here and bring them to their top tax rate of 12%. So 12%, if we did any type of conversions, would be the starting place, because any money that comes out of an IRA or a 401k is taxed at your top tax rate of income and goes from there depending on how much you convert. And then, as we said, they have $650,000 in 401ks, and then a minimal amount, let's say $10,000 in bank accounts just for liquidity, and we always want clients to have at minimum $10,000 for access to eliminate need for credit cards and things like that. And then currently 0 tax-free accounts like Roth positions currently, or properly structured life insurance plans. So as we look at this, we've got to consider if 12% as a starting conversion rate is a good thing compared to what those tax rates could be later. Because whenever we walk through this example with people, I'm going to get a little thicker. We've got to factor in what we have as income today, but also where that income will potentially be later, because that will impact whether making a Roth conversion today makes sense or not. So as we look at this, what we're going to do is illustrate that with a very simple example with round numbers, and it's going to look at if we decide to not do conversions versus if we decide to do conversions, and what factors impact whether that's a good decision for you or not. So if you've got a 401k and you decide to do nothing, which a lot of people are not paying attention to this, so they're by default in this category, nothing changes with your position. If you decide to do, in this case, $100,000 of conversion, that would go on top of the $50,000 of taxable income that this particular family has. And let's say, just for round number's sake, the effective tax rate for this conversion is 20%. That means they could, or in this case they would need to, since they don't have a large amount of after-tax monies, take a withholding from this 100 that's converted for the taxes, and then their net amount that is converted would be $80,000. So again, when we look at, financial advisors will a lot of times tell you this is a reason not to do a Roth conversion. And then there really won't be more discussion, because they say, well, if the market goes up, let's say 10%, this account's going to grow faster than this one will. And so people don't want to grow slower, so they make a decision not to do a Roth, even though that's not really the thing that we've got to pay attention to, because that growth of 10,000 taxable dollars could be worse or better than the tax-free growth here, but it depends on what happens later when you take the monies out. So for this example, let's say both of these monies are invested the same way, to where they both double over time, and then we've got $160,000 in the Roth, we've got $200,000 in the 401k. We've got to see what happens if we go to take these monies out later. Well, if we're assuming that this is longer than 5 years, the Roth, all that you take out, doesn't matter how much, will be tax-free. So $160,000 to you from the $160,000 account value. The 401k, it depends on the tax brackets at the time, and if the tax rate later is the same 20% that we started with and converted at, what you will notice is the bottom line number in both of these scenarios is exactly the same. 160 of 401k net of taxes, 160 of Roth net of taxes. So as we look at this, if you knew your taxes were not going to change, it doesn't matter which decision you make. It's just whether you pay the taxes now or you pay them later. The reason that most people don't do Roth conversions is based on traditional advice of the fact that most people, when they got to their retirement years, did not have as much income or maybe didn't need as much income. And so that meant that their tax rates typically went down. And if that was the case, you'll notice the math works out in favor of the 401k, even though this account's been growing tax-free. So sometimes people hear tax-free is always good. Not necessarily. If your taxes are lower later, tax-free would cost you money if you made that move today. The reason, though, I don't think that this is going to be relevant for many people is because of what's happening in our government system in the way that it's going to affect your income taxes in the future. What we are experiencing now is a time where we are overspending as a government by a pretty large percentage. And since we've been doing that for several years, that started to accumulate massive amounts of debt to the tune where we now owe $30 trillion or over $30 trillion as a government, and the government doesn't have money of its own that it just provides a service or makes something and generates. It receives income through tax revenue largely. So the way to fix this is decrease spending is one option. The other option is increase the amount of income, and that will happen through increase in taxes. So if that is the case, and income taxes go up for this particular individual over time to the tune of, instead of being 20%, let's say 30% is the tax bite on these dollars, what you will notice is that has a direct impact to what they take home out of this money, which means they would have $140,000 instead of $160,000. And so Roth converting now, in this case, makes sense because the tax percentage is lower today than it would be at the time that they take the dollars out. Now, what's interesting is sometimes people will look at this and they'll say, well, yeah, this is you're having a much higher percentage later because you've got a much higher withdrawal. Well, depending on your mix of income, this could be your baseline starting income, depending on what the mix of taxable assets are that you have. Because if you've got Social Security income, which is taxable, pension income, which is taxable, distributions from rental properties or dividends, and then you take monies out of your IRA or 401k, even if you don't need that income, you're going to be forced to take it out at some point. So this is not I don't need this money. You could give it to charity, but other than that, you're going to have to pay the tax on it. So as we look at this, all those different income sources that we have will stack on top of each other, and then your first dollar coming out of your 401k will be taxed at that level, not your starting level. So we've got to look at it and say, okay, in this particular situation today, where will that starting income be at versus where that, by percentage, versus where that could be later at an equivalent income set. So in 2023, for this couple, they just get above the 10% bracket to where that first dollar would technically be taxed at the 12% tax rate. So 12% would be our starting rate of conversion. As we look at this, I'm going to jump this up and zoom in to where you see 2017. This is actually what the tax brackets will be in 2026. They will revert back to the brackets in 2017. These are adjusted though for inflation to be today's values. And you see this would be a 15% start instead of a 12%. So you've already got an increase on that $50,000 just by seeing what happens 3 years from now. And then I'll show this example. 1981, nobody's throwing this out as a prediction, but this was the last time that we had a significantly higher tax situation, especially the higher your income got, because these are adjusted for inflation to be today's values. So $100,000 in today's money was roughly $30,000 in 1981. So as we look at this, top tax bracket today is 37%. As you notice here, top tax bracket 70%. So taxes were almost double. But if we're looking at where this particular family would start paying taxes, it would be at the 21% tax rate going for the next $9,000 of conversion. So as we look at this, 21 is not quite double where they start at today, but pretty healthy percentage larger as we look at this, because they could convert at the 12% bracket today if they waited until 2017, but really 2026 is when these could go into effect. And again, could is the way, because the government could change taxes before 2026 if they want to. 15% would be their starting rate of conversion, and then the starting distribution tax, if things got to 1981, would be 21%. I think that for this particular scenario, what you're looking at is a starting tax rate between this 15 and 21, because this is not going to be enough of an increase to fix all the overspending that's happening. I think you're going to start to see drastically higher, especially higher that people's income goes, the more impactful this starting tax rate is going to be on those 401k monies. So in this particular situation, how much should we convert? Well, again, if we're looking at a 15% tax rate, what's interesting is, and again, this helps you understand the way money is taxed. So again, this family was barely in the 12% tax bracket, so if they maximize the rest of that 12% tax bracket, they could convert $67,000 and change of dollars out of that 401k. And then if they were trying to play this to where their effective rate of conversion would be less than 15%, you just start doing the math and see how much makes sense to convert at 22% to where your effective tax rate is lower than what that 15% would be later. So 25,000 is roughly where that would be. So 92,150 of conversion is what we're looking at here, with an effective tax rate of 14.7% or less than 15%. And again, that gets that money to where of the 650,000 that's in 401ks now, they're migrating and moving 92,000 over, less the taxes, and then that would give them a good start to a tax-free bucket and not having to wait to access those, since this particular couple is at age 59 and a half. So as we look at this, this seems like a lot. I know it does, but if no one has ever had this type of conversation with you, you probably don't have a tax plan. And you probably want to investigate this to see if now is a time for you to pay taxes instead of missing an opportunity to maybe have the lowest tax percentages that you'll see the rest of your life. So what I would invite you to do, you're going to see a link pop up. What I'd ask you to do is click that. That will get you in touch to our calendar where you can sit down or talk to one of our wealth planners. And again, see if this type of information makes sense for you. Because again, we're talking to people all the time. Sometimes this doesn't make sense to do now, sometimes it does, and then we help them walk through that process of what to do, how much to do, and where to potentially pay for those taxes. So we would enjoy having that conversation with you, seeing how we can help. If you would like to help us, please like, share, and subscribe this video. Leave us any comments that you have. We'll be happy to reply to those, but also